Welcome to this deep dive. Today, our focus is on a specific presentation slide deck detailing the Defiance AI and Power Infrastructure ETF, which goes by the ticker symbol AIPO. The issuer or sponsor is Defiance ETFs, LLC, and the advisor is Title Investments, LLC. The inception date is listed as 24 July 2025.
Right.
Its focus is U.S.-listed AI hardware, data center, and power infrastructure equities. And the date of update for this deck is September 2026.
And looking at the disclaimer details, it states verbatim that the presentation is for general educational and entertainment purposes, not financial advice, nor an offer or recommendation to buy or sell securities. And it also notes the standard closures like views are personal, past performance is not indicative of future results, and listeners should consult a licensed financial advisor.
Got it. I am now moving to the next slide.
Okay.
Slide 2 is the ETF snapshot. I'll read the core identifiers and fun facts. Ticker details are AIPO on NASDAQ, CSIP 88636R479, ISN US 88636R4790. Domicile is the United States.
Right.
Assets under management, or AUM, is US $930.80 million in net assets as of 25 August 2026, and the expense ratio is 0.69% per annum.
In detailing the thematic equity asset class breakdown, industrials constitute the majority at 55.2%. Then infotech is at 17.8%.
Okay.
Utilities at 16.5%, and energy at 8.2%. The fund utilizes physical replication, meaning it holds all or a representative sample of index components.
So detailing the dividends data, the dividend yield is 0.09% as of 31 July 2026. The projected next dividend is 0.0025. The fund operates on an annual distributing schedule, and the sole distribution to date being US $0.00025,135 per share, with an ex-dividend date of 30 December 2025.
And for the performance data, the one-year annualized performance is plus 39.18%. The 3-year and 5-year metrics are not applicable due to the July 2025 inception. Since inception, performance is plus 42.09% for the net asset value as of 31 July 2026.
I am now moving to the next slide.
Right.
Slide 3 introduces the top holdings. The top 10 holdings by weight account for a total of 56.65% of the ETF's AUM. I'll read the first 5 companies with their exact ticker, weight, price to earnings or PE, and price to book or PB ratios. First is Eaton Corporation PLE, ETN, 9.12% weight, 42.70 PE, 8.04 PB. Next is GE Vernova Inc., GEV, 8.98% weight, 27.28 PE, 21.23 PB. Third, Quanta Services Inc., PWR, 7.73% weight, 71.18 PE, 9.70 PB. Fourth is Vertiv Holdings Co., VRT, 7.44% weight, 60.94 PE, 21.34 PB.
What's fascinating here is the extreme variance in PE ratios among these top weightings. Specifically, if you know Cameco's high ratio of 188.21 and you compare that to GE Vernova's 27.28.
Yeah, that's quite a gap. Continuing the list, the remaining 5 holdings are NVIDIA Corporation, NVDA, 4.27% weight, 26.51 PE, 22.07 PB.
Okay.
Then Bloom Energy Corporation, BE, 4.23% weight, 39.71 PE. Constellation Energy Corporation, CEG,
Right.
4.23% weight, 19.29 PE, 3.11 PB.
Right.
Broadcom Inc., AVGO, 3.90% weight, 102.75 PE, 11.68 PB.
And noting the total aggregate metrics provided for the index, it has a PE of 61.3 and a PB of 16.18.
Here's where it gets really interesting. I am now moving to the next slide.
Let's see it.
Slide 4 covers the AIPO weighted PE. It details the aggregated weighted price to earnings of the top 10 holdings held at their current weights. The current weighted PE is 61.3x. The mean is 57.8x. The standard deviation is 8.5x. And the current versus mean is plus 0.41 standard deviations.
Right, so reading the slide's direct observation, it states the current weighted PE is above its own mean, but it remains inside one standard deviation. The historical series has swung between 47x and 72x. Therefore, the current reading of 61.3x is not considered an outlier.
Well, I have a pushback based strictly on the slide data. It's a mathematical reality. If the series has gone as high as 72x and the standard deviation is 8.5x, then the current 61.3x is actually quite close to the historical average, being only plus 0.41 standard deviations away. Okay. I am now moving to the next slide.
Okay, slide 5.
Slide 5 is pure comparison. It introduces the comparison between AIPO and the 5 largest U.S.-listed ETFs of comparable theme by AUM. I'll read the metrics for AIPO and the top 2 peers.
Right.
AIPO AUM US $0.93 billion, expense ratio 0.69%, div yield 0.09%, 1-year return 43.15%, Since inception, 40.05%. Next is PAV, Global X U.S. Infrastructure Development, AUM U.S. 13.76 billion, ER 0.47%, div yield 0.77%, 1-year return 20.70%, since inception 15.81%. Then GRA, First Trust Smart Grid Infrastructure, IUM U.S. 11.82 billion, ER 0.56%, div yield 0.37%, div yield 2.94%, 1-year return 11.46%, since inception 4.71%.
Got it. Then IFRA, iShares U.S. Infrastructure, AUM U.S. 4.63 billion, ER 0.30%, div yield 1.57%, 1-year return 23.20%, since inception 13.50%. And finally, DTCR, Global X Data Center and Digital Infrastructure, AUM US 2.19 billion, ER 0.50%, div yield 0.87%, 1-year return 51.81%, since inception 13.73%.
So synthesizing the text on the slide, the written analysis states AIPO is the smallest fund by a wide margin and the most expensive at 0.69% versus a peer range of 0.30% to 0.56%. It charges 23% more than GRID and more than twice IFRA. It posted the second highest 1-year return at 43.15%, behind DTCR at 51.81%.
That's accurate. And closing the slide, it notes a final point. AIPO's 40.05% since inception figure covers barely 13 months, making it non-comparable to peers that have 6 to 19 years of history.
I am now moving to the next slide.
All right.
Slide 6, details. Recent news for the fund itself over the past 12 months. AIPO assets grew roughly tenfold in 12 months. Defiance announced successive AUM milestones of US 100 million, US 200 million, US 300 million, and US 500 million since the July 2025 launch, reaching US 930.80 million by 25 August 2026. The slide text states this scale is important because it reduces the closure risk that shadows new thematic funds.
Adding to that, under Fund Awards, AIPO was named Best New Thematic ETF at the 2026 ETF.com Awards, announced at Future Proof Citywide in Miami in March 2026, signaling advisor channel recognition for a first mover in the AI power theme.
Okay. Reading the holding news for Eaton, ETN. Eaton, accounting for 9.12% of the fund, was named among 9 industrial stocks positioned for the sector's rally, in coverage examining whether industrial valuations remain supportable based on growth prospects.
And detailing the news for GE Vernova, GEV, which is 8.98% of the fund. Q2 2026 results missed on profit, causing shares to fall about 7%. This occurred even though the company raised 2026 revenue guidance by US $1 billion and flagged tariff pressure. The slide explicitly states this is the clearest recent illustration of how high the bar has become for AI power names.
Oh, wow.
This raises an important question regarding the polarized broker response to GE Vernova. Brokers move price targets in both directions. Guggenheim, Morgan Stanley, RBC, JP Morgan, Bernstein, Oppenheimer, and TD Cowen raised their targets.
Right.
While Citi cut its target to US $1,125. Furthermore, Shine joined a GE Vernova-led ARPA-E project on nuclear fuel recycling, extending GE Vernova's nuclear positioning beyond gas turbines.
So what does this all mean? We have successfully progressed through the factual data of the presentation, observing the exact sector weightings, PE multiples, peer comparisons, and recent news events.
And why this matters to the learner is that by isolating the literal data, such as the exact AUM growth alongside the highest expense ratio in its peer group, listeners are equipped with the raw factual architecture of the fund without narrative distraction.
Exactly. And I want to leave the listener with a final provocative thought derived strictly from the presented data, but not explicitly analyzed in the text. Given that AIPO is the most expensive ETF in its peer group at a 0.69% expense ratio and has the lowest dividend yield at 0.09%, yet experienced a tenfold AUM growth in 12 months up to nearly $1 billion, one must wonder, are investors in new thematic ETFs completely discarding traditional evaluation metrics like cost and yield in favor of pure, concentrated exposure to high momentum, narrow theme narratives?
That is absolutely the question to explore.
It really is. Thank you for joining this data-driven deep dive. We will catch you on the next one.